Welcome everybody to the Enterprise Development Property Fund and our 50 by 4 challenge. By now you should know what it's all about. I am here with my friend Anton at Empire Wealth talking about the 15 proven ways in which to use other people's money to build a property portfolio. So the first video we spoke about bank finance. Now today we're going to talk about bank sureties. So Anton, tell us all about bank sureties and how you can use it to build your property portfolio.
Absolutely. So in the first video when we spoke about bank finance, we used the structure where you as the director stand surety for a company.
Correct,
so that the company can get finance even though it doesn't have a track record or financial statements or anything like that. Now surety in this case is where someone else stands surety for you.
Okay, excellent.
So that might typically be when you're in either in the financial position where you can't get finance because there's adverse payment records against your profile or whatever the case might be. You might even have blacklistings or judgments. Or the second scenario is you don't have a sustainable income in order to prove affordability to the banks. You might be a contract worker, you might not work at all, be early in your career earning a small amount, whatever the case might be. Where someone else then with a sustainable, consistent income comes on board and stands surety for you for that property finance. In other words, they give the bank an undertaking that in the event that you can't pay for the property, that they will.
Fantastic.
So that person then also gets registered as a surety on the finance. And also that can be multiple persons, right? So you can get 3 or 4 or even 5 people to stand surety for you, or in this case for the company that you use to buy investment property. And their joint affordability would then be taken into account for the home loan finance amount calculation.
Fantastic. Okay, so we could then ask family, friends, maybe a business partner and invest into the business, and they obviously would want something in return.
Yes.
And for that, you probably either give them a share in the profits or maybe even a stake in the business.
Or a stake in the business, or if it's family, usually a box of chocolates. I always tell the story about our Empire Wealth's youngest client being a 19-year-old flight attendant on a third property because the dad stood surety for the first 2, and then she used that rental income to buy the third one standing finance on her own.
Fantastic. All right, guys, there you have it. So the second method in which you can raise money using other people's money is bank sureties, where it's basically the same as taking out a bank loan, but instead of you personally standing surety, somebody else will stand surety on your behalf. So thank you again, Anton, for your time. Thank you again, viewers, for listening to us, and we look forward to talking to you about the third method in which you can use other people's money to build a property portfolio. So this is Nigel signing off again. Thank you.